Hello, everyone. I just want to thank you guys for joining us today. My name is Harley Moore Wilson. I work for the Native Agricultural Financial Services. We are a uh, reliable and trusted partner in providing capital to support agricultural production, rural business development, and rural infrastructure for Native American farmers, ranchers, and agricultural communities. The webinar series today that you're joining us is a part of what we would call Ag FTAP, Agricultural Finance, Tax, and Asset Production. This program, seeks to enhance farmer and ranchers' abilities to understand and navigate the farm business tax, protection, decisions for their operations, as well as important relationships between federal income tax and the USDA Farm Service programs. We are going to be recording today. You should have received a notification. The recording will go onto our YouTube page at Native Ag Finance. And I will also share a link out in a email later in the week that has a link to that recording, along with the presentation from Mr. Rob and a few other details. Feel free to rewatch the recording or share with any family and friends. Some other housekeeping that we have is if you guys have any questions, um, please put them in the chat or the Q&A box, or feel free to write them down and wait until the very end of the presentation. I will promote everybody to be able to speak, and you'll be able to have that one-on-one conversation with Mr. Rob. He loves questions, so feel free to think of all of the really hard questions. At this point in time, I am going to stop sharing my screen so Mr. Rob can start sharing his screen. And I'm going to go ahead and turn it over. Um, and we'll get started here. And I can see your screen, so you're doing okay, Mr. Rob.
Okay, I'm gonna do one. Whoops. All right. Okay, are we coming through full screen? I guess would be the
Yes.
question. Okay, good. Because uh, I already told you we flip back to the office here. So all right. Well, Harley, thank you so much. Welcome everybody. It's a pleasure to be back with this group. I guess I've been doing these presentations now for a few years, and I really appreciate the invite back. Today's talk is going to be on primarily a tax update for 2025. And like Harley said, my name is Rob Holcomb. I'm a regional extension educator with the University of Minnesota. I'm officed out of Southwest Minnesota. I'm from Marshall, Minnesota, and I'm coming to you from my office today. So, without any further ado, I'm going to go ahead and jump on into it. The This is a disclaimer that I normally throw up when I do either tax or farm estate transfer talks, or really, anything business entity talks is another thing that I would use this for. Uh, when it comes to income tax issues, be a good consumer of professional services, meaning I don't want to disparage any of the off-the-shelf tax software that you can buy at Walmart, Costco, Sam's Club. They're all good software programs, but if you aren't really in tune with all the tax laws, it it can be a disastrous end. All right. They don't ask all the questions that need to be asked for a farm return. So I really encourage you, be a good consumer of professional services. I oftentimes have thought through my 35-year career of doing this kind of work is, folks that self-prepare returns, especially business returns, really do themselves a disservice. I've very rarely ever picked up one of those returns where it wasn't really laced with errors. So I think that's some of the best money that you're ever going to spend. Now, material that we're drawing from today, Minnesota happens to be a member of the Land Grant University Tax Education Foundation. That organization puts out educational materials that we use for our tax courses that we teach here at the University of Minnesota, and that material is used by 20 other land grant universities across the country. I happen to also be the director of the tax schools for the University of Minnesota, so that's just one of the other roles that I have. Another source of information that I might draw to you, and this is public free information, ruraltax.org. You can either use that ruraltax.org, or the QR code will get you to that website. This is a website that's populated largely by fact sheets that are written by members of the National Extension Income Tax Education Committee. And there's a wide variety of fact sheets and information. There's also tax planning tools on there. I encourage you to check it out. Everything on there is grant funded through USDA and is free of charge. Also, some material I'm going to have here today was came right off the IRS website as well. So, agenda items. I anticipate we're probably going to do presentation for a little over an hour, maybe an hour, 10 minutes or so, and then I'll dive into Q&A. And as far as the Q&A folks goes, if you put a question in there, that's fine. I'm probably just going to address those questions at the end. I'm probably not going to jump in and take care of any of those while we're going through here. My agenda today is I want to talk a little bit about the new legislation that was passed, signed into law July 4th. It goes by many names. Well, one big beautiful bill act, that was the full name, OBA for short. It also was called HR1, and I'm probably going to bounce back between OBA and HR1, but we'll talk a little bit about that new legislation, what kind of impacts it's going to have for farmers. I also normally go through an income tax refresher, and that's just talking about some basic components of income and expense, and tie it in a little bit with your record keeping, but and it's also going to impact your year-end tax planning. Then I'll wrap it up with some income tax planning strategies. I've got a sample tax planning problem that we'll look at, and with some charts, and I can show you what kind of an impact prepayments are going to have, or taking additional expense on a particular tax return is going to have. So without any further ado, let's go ahead and dive into this. Now, on the One Big Beautiful Bill Act, or OBA, also called HR1, this was signed into law by President Trump back on the 4th of July, and it's a huge piece of legislation from a tax standpoint. All right, it includes 12.9 trillion in tax provisions. So to say this is a big bill, it's is really an understatement. Now, the bad part about this legislation is CBO, Congressional Budget Office, is predicting that it's going to add quite a bit of money to the deficit over the next 10 years. And the that's not a political statement, that's just a statement of fact. So uh right now, I mean, that is a concern that I have moving forward, because right now national debt exceeds the GDP right now, and that is a concern of mine. The and But largely what HR1 did is it extended or made permanent a lot of the provisions of the Tax Cuts and Jobs Act, which was the piece of legislation that was passed back in 2017 during President Trump's first administration. So there were many of those provisions from the 2017 legislation that were set to expire at the end of 2025. HR1 extended a lot of those provisions, some of those provisions it made impermanent. So what we want to do is just look at a few of these things that might affect farmers on this. Now, first of all, the estate and gift tax exemption. Now, it does permanently increase the exemption to 15 million per person for federal estates. Right now, that not only bumped the number, but it made that exemption permanent. 2017 legislation bumped that number, but it was set to go back to 5 million index for inflation without the passage of the legislation last summer. The other thing that it did was 100% bonus depreciation. Now, bonus depreciation is something that you can take on purchased capital assets that happen to be qualifying for bonus. Now, later on when we're talking about depreciation, bonus depreciation essentially works for anything from 3 through 20-year property. All right, and we'll look at that chart a little bit later. But what that allows us to do is it allows us to do a fast write-off on those assets that we might purchase. And that might be anything from machinery all the way up to a machine shed that would fall into that. 179 expensing also made that provision permanent. What HR1 did is it set the 179 limit to 2.5 million with a $4 million purchasing limit. And that's been set permanently in an index for inflation moving forward. And again, 179 is something that we can use to write off those purchased capital purchases, all right, such as anything from machinery to breeding livestock, all the way up to drainage tile. Next, qualified business income deduction, all right, or QBI as we call that. The QBI was a 20% deduction that was put in place on business income from the 2017 legislation, and HR1 made that permanent. And what that amounts to is, and we'll get to more details on that. It depends for 2025. It depends on when the asset was purchased. I'll address that when we get a little bit later into the program. Also, HR1 set up some ag loan interest exclusions. So there, if you got ag interest, this is mainly something that affects the banks. All right, largely just affecting banks. So it also made some farm program payment changes. So what it did to our farm program payments, like for PLC and Arc County, Arc Individual, is it increased those statutory reference prices. Right, it bumped those reference prices from what we had from the previous farm bill, which needed to happen because with inflationary forces, those old reference prices were just completely out of date. But it also provides producers an opportunity to upgrade you can update your base acres. All right. And you don't oftentimes get a chance to update base acres. I think the last time I recall you were able to do that was with the 2014 Farm Bill. And folks, it never hurt. You're never going to get hurt by updating your base acres. All right. Absolutely never going to get hurt on that. Now, a couple more things here on the permanent tax provisions. Commodity payment limits. This was another thing that changed. Now, prior to the passage of HR1, there was a $125,000 payment limit for individuals and certain entities. All right. Now what that meant is that if you were getting farm program payments, your limitation was $125,000 per individual. Now, that limit also applied to business entities. If you had a business entity that you had to go to the Secretary of State to file a charter for, such as a limited liability company, also called an LLC, actually any type of limited liability business, period, that you had to go to the Secretary of State to charter, S corps, C corps, anything that you had to go to the Secretary of State, that limit was applied at the entity level and not the individual level. And that was another thing that was changed with HR1, is it changed that to be the individual in those entities, and not just the entity itself. So it did increase some flexibility because prior to that law passage, somebody that was in a general partnership, the partnership, a general partnership was not limited at the entity level. It was only the partners. All right, S corps, C corp, all pass through entities with limited liability companies, S corporations, all those pass through entities. It's then going to be based on that individual pass through is what's going to happen. Plus, crop insurance. It increased subsidies for crop insurance is another item that it did. A couple other things that we want to talk about here is the new legislation also set up a temporary deduction for seniors. All right, now this is a temporary provision. It only runs 2025 through 2028, but for somebody that's 65 years of age at the end of the year, you got to be 65 on December 31st, right? And if you are, you end up getting a $6,000 deduction that you get to take on the 1040. And in this case here, if you got seniors that are married and each spouse is over 65, you got to file a joint return on that. All right, but and if one individual is 65 and the other one isn't, well, the person that's over 65 can take that $6,000 deduction. There are phase outs on this, and the PowerPoint lists those phase outs. If income goes above a certain level, you're not going to be able to take that deduction, is what it does. It phases out that deductibility. All right, so I want to move on here a little bit and talk a little bit about a tax refresher. Now, what this tax refresher does is we're just going to look at some basic definitions of uh, defining some income and some expense. There's different categories of income, and we just want to talk about those things a little bit. So hopefully some of this tax stuff makes a little more sense. Now, ordinary farm income. All right. Now, ordinary farm income is something that's going to be reported on your Schedule F on your tax return. Now, it's typically going to be income from the sale of commodities, livestock, possibly custom services. And let's put some definition to this. All right. If I'm I don't farm, but if I farmed here in Southwest Minnesota and I sold corn to the ethanol plant here in town, that's going to be ordinary farm income. I'm going to report that income on my Schedule F on my 1040. It's going to be taxed at whatever tax rate that I'm in. Plus, since it's business income, I'm going to pay self-employment tax on that as well. Right. So for business income, we have to worry about regular tax, and we also have to worry about self-employment tax. Right. And they're calculated separately, but they get all lumped together when we calculate the tax bill. Now, a couple things that I want to clarify here. On the livestock side, all right, if you happen to be a cow-calf producer, for instance, all right, and you're selling calves, right, you're selling raised calves, that's going to be Schedule F. Now, what you have to differentiate, folks, is if you're selling breeding stock, that's not ordinary farm income. That goes in a different spot. All right. Breeding stock does not get sold on Schedule F. All right. It gets sold on a different form. We'll get there here in just a minute. All right. Now let's talk about capital assets. Now, capital assets, this is not the textbook definition. I want to make that very clear. If you open up an accounting book, it's not going to agree with what I'm saying. But what the layman's terms definition for a capital asset is anything that we buy or sell. Well, let's just talk about the buying side of things. Anything that we buy that we really can't deduct the whole thing at the time that we buy it. All right, we're going to be forced to depreciate it over time, or we can't take a deduction for it at all. Whatever we paid for it, its basis just goes up on the shelf, and we don't get to take that until we actually sell it. All right, so that's kind of a loose definition of capital assets. Now, when you sell a capital asset, all right, depending on how long you hang on to it, different types of assets have different holding periods. And if you, long as you hold that asset for that holding period, you get long-term capital gain treatment, which is a lower tax rate than ordinary income rates. Right? So long-term capital gain is a good thing. All right, it's a lower rate than if we were to slap it on the Schedule F. Right? And that's important to know. All right, so sale of capital assets. It's either going to be taxed as depreciation recapture, which is ordinary income, or we get capital gain treatment, right? And we'll look at the rates to compare that a little bit later. Now, some other things that might show up on your tax return. All right, let's say, for instance, that you have W-2 income. All right, you got an off-farm job, you get a W-2. How's that get taxed? Well, if I'm doing your return, you bring me the W-2, I'm going to type all the information into the software. That largely that box one that you have on your W-2, that's going to show as income on the W-2 line on the tax return, and you're going to pay whatever your regular tax rate is on that income. And that's pretty much where that is. Wage income is whatever the bracket is that you're in, and the rate's going to depend on how much income that you have. Now, what we want to be real clear about is the U.S. tax system is a progressive system, meaning that we got rates that start at 10% and go all the way up to 37%. Now, you got to have a massive amount of money to get up to that 37% bracket. But what you do is you add up all the income on the return, and then we apply it to those tax brackets. All right, so well, if you got enough income where you're gonna fill up the 10% bracket, well, you're gonna pay 10% on that amount of money. And then it jumps to a 12% bracket, and you're gonna pay 12% on whatever money that's in that bracket. So just because you happen to hit a higher bracket, it doesn't mean everything gets taxed at that bracket. It's a staircase type of thing. You fill up the lower bracket and you pay that lower rate on that lower money, and then the higher income that you have, you start to get into the higher brackets, but you only pay that higher bracket on the amount of money that's in that bracket. All right, and some folks misunderstand that. Now, we talked about self-employment tax a little bit earlier. All right, self-employment tax is something that it gets paid on self-employment business income. So Schedule F income, farm income reported on Schedule F, is going to be subject to self-employment tax. It's a total of 15.3% broken out by two components. All right. OASDI stands for Old Age Survivor Disability Insurance. That's a 12.5%. And then you got a 2.8% Medicare portion on that. So that OASDI cap is for 2024 was 168.6. That's something, I apologize, folks. I missed updating that. All right, we're close to 180,000 on that this year. So that number did get adjusted for inflation. It's important when we get to the tax planning part of this to note that, because that 12.5%, once we hit that high mark, we stop paying that 12.5%, but we pay the 2.8 out into infinity is what we're going to do. All right. Rental income. If you happen to be renting something out, say you have a rental house or something along those lines, okay, that's taxed as ordinary income, but you don't pay self-employment tax on that. So that differs. Investment income is typically not going to be subject to self-employment tax. All right. Wage income, taxed at whatever bracket that you're in, but on your W-2, you're going to notice, if you ever studied your W-2, there's also a FICA and Medicare withholding that shows up on that W-2. That's the self-employment tax on it. On the FICA and Medicare make up the self-employment tax on your W-2. So that's what essentially that makes that work. All right, depreciation. All right, let's just go a little bit into this. So i- anything that we buy in the way of capital assets, except land. Land is pretty much the only exception. We can't depreciate land. If I buy a piece of bare land, whatever I paid for, it's my basis. It goes up on the shelf, and I can use that as a deduction if I ever turn around and sell it. Right? But there's no deduction for the actual purchase of land. All right. But if I buy other capital assets like machinery, or if I buy breeding livestock, like if I buy a mama cow or a bull, if I put up a building, if I install drainage tile, all right, all of those assets, whatever I paid for them, I can't deduct that all in the year that I purchased it. I'm going to have to put that on a depreciation schedule, and I'm going to have to spread that thing out over time. And the length of time is determined by what category of the asset is in. And we got a chart coming up that's going to explain that a little bit better. So depreciation is any of that stuff that we're buying in the way of capital assets that we have to depreciate. Now, the exception is, and this is the part where a lot of folks just taxes drive people nuts. And this is one of those rules that came out several years ago. IRS updated the tangible property regulations. We also call those the repair regulations. And what those repair regulations do is they specify, if we're buying a capital asset that happens to be under a certain dollar amount, we can just write it off. All right. So there are exceptions to that, but there's dollar limits that are associated with that. All right. So if I sell a capital asset, all right, and we've got an example coming up on the very next slide. All right. So if I sell, say, for instance, a piece of machinery, all right, that's going to be taxed as depreciation recapture, all right, which is a fancy word for that. But what depreciation recapture is it get taxed as ordinary income, but we don't pay self-employment tax on it. It gets reported on 4797. But let's look at this example. All right. Now, let's say, for instance, that I sold a utility tractor, all right, for $20,000. Now, what I did is I bought this tractor several years ago and I've completely written it off. I took Section 179 on it when I bought it. It's it's got zero basis. So if I sell it for 20,000, I got zero basis. I've got a $20,000 gain on that sale. All right. And that's going to be depreciation recapture because I'm recapturing that depreciation that I originally took on that particular item. Now, this is a rule on like kind exchanges that's been around since 2017. I still occasionally run into folks that are unaware of this. Now, the Tax Cuts and Jobs Act, that was the 2017 legislation, is what made this change. Prior to 2017, what we were able to do is we were able to do like kind exchanges on machinery trades. So if I had a tractor that I was using in my farming operation and I took it to the implement dealer, I'm going to get a different tractor. So what I did is I'm trading in my old tractor for a new one. The dealer gives me an allowance for the tractor that I'm trading in. I give him the cash difference and I'd be able to bring the new tractor home and I wouldn't have any tax consequence to that. All right, that changed in 2017. Now that machine that I trade in is a deemed sale. All right. So let's look at the old method. This is pre 2017. If I if I traded in a if I traded in a tractor and the dealer gave me a $20,000 allowance, all right, but the new tractor that I was buying cost $45,000. What you know I go into the dealership. I want to buy a $45,000 tractor. I trade in my old one. He gives me 20,000 for the old trade. I give him $25,000 and I walk out with a new tractor. We didn't have to report any income at all. All right. That was the old method. That's not the way it is now. All right. Now, since 2017, what ends up happening, we got the same thing here. All right. I'm buying a $45,000 tractor. I trade in the $20,000 used tractor. I'm going to end up paying 45,000 total for the new tractor, and this ends up going on my books as a sale. All right, the 20,000 is going to be a deemed sale. I'm going to pay tax on that. All right, so that's what's different now compared to pre-2017. All right. Capital gains rates. Now, the only way I get capital gains rates on a machinery sale like that is if I sell it for more than what I originally paid for it. And it's only that amount that's above what I paid for it. So typically machinery sales are not going to be subject to capital gains. It just never, hardly, it can happen, but it never does. Now, the typical things that are going to get capital gains treatment in the farming operation is going to be if you sell off a parcel of land. Okay, that as long as you've held on to the land for a year or more, you're going to get long-term capital gain treatment. The other thing where you're going to get capital gain treatment is if you've got raised breeding stock. For instance, if you got a raised mama cow that you didn't buy, but you raised, and when she was a heifer, you put her in the breeding herd. You hang on to her for 5 years, sell her. She gets long term capital gain treatment. So those are going to be your two most common cases that you're going to find capital gain treatment in the farming operation. Now, our 2025 long-term capital gains. All right. If this is based on holding that asset for 12 months or more, you'll notice here. Let me turn on my little laser pointer here thing here. Okay, you'll notice that there is a 0% bracket. Now, this has been something. This 0% bracket's been around since 2017, and what that means is if we have capital gains that we're reporting in 2025, what we do on the what the tax return does is it takes all the income and stacks it, right, that we have on the return, and it puts the capital gains on at the very top. All right. Now, if I stack all the income and I put the capital gains on top. If I'm filing a married filing joint return, say my wife and I are filing a joint return together, and that any of that capital gain falls below 96,699, I'm going to get 0% capital gain treatment on that capital gain that is below the 96,699. All right. So that's where the capital gain gets 0%. All right. And it's very possible. All right. Typically we'll see that like in a land sale or capital gain could be sale of raised breeding stock, land sale. Those are going to be the two most common things. So it again, it's advantageous to make sure in your records when you're selling breeding stock, make sure that you code it right so that your tax accountant can get that in the right spot. Because unless you've got a lot of income on your return, you're probably going to be able to sell those mama cows off for 0%. All right, so that's just good tax management on that. Okay, let's drive on here a little bit. Now, the major thing that we want to talk about here, and we're about half done. Um, on our tax management planning, what we're going to do is we're going to talk a little bit about some techniques to use to try and get yourself in that sweet spot for where you want to be for tax planning. Now, this is a chart. Excuse me. Okay, tax planning. Okay, here's a chart that I've used for years. That what we do with this is if you look at this chart, I've got my little laser pointer here. Now, what the blue line here is, blue line represents the tax rate. All right, so I mentioned earlier we got a little bit of a 10% bracket. We got a 12% bracket, and then we jump to a 22% bracket, and then it jumps to a 24% bracket out here. All right, and it keeps going on and on and on all the way up to a 37% bracket, way out farther right for where we're going here. All right, so the kind of the orange dotted line here is our self-employment tax, 15.3%. Now, I mentioned that goes out until about 180,000, right? Because at 180,000, the 12.5% OASDIA portion drops off. And what we're left with is the 2.8% Medicare portion that goes out here into infinity. All right. The green line is just combining the two. Now, this, when I tax plan somebody, this is a chart that I whip out. And what we do is, we sit down and we look at their books. I usually like to have them bring a detailed report. Other people might call that a general ledger. But what I'm going to do is I'm going to scan through the records and make sure that there's nothing that I notice immediately that may need to be changed from a coding standpoint. Make sure everything is categorized properly. But we look at how much income that they've got on the books so far. For instance, if we were to do, if we were to do a tax plan today, all right, today's the 15th of December. All right, they'd bring in their stuff and we'd look at, all right, today's December 15th. Here's where we stand right now. Total income, total expense, the amount of depreciation that we're going to be able to take with what's on the books right now. And what we'll do is we'll look at this chart. All right. So, if that person happens to be like right up here in the middle of the big green hump where they're paying a lot of tax, they're getting close to 40% marginal rate. If they had income here. So what we do then is we talk about, all right, is there any more income that you have to take before the end of the year? And if so, well, we adjust that. We adjust where that number is going to be at. And then we look at what kind of expenses are you looking at having before the end of the year? Because we only got a couple weeks left of the year. And we try to arrive at, all right, where are we kind of looking at landing? And then we start talking about maybe doing some prepayments. If the income is really high, we'll look at maybe doing some prepayments, trying to look at trying to get maybe income from here down to here and get ourselves to where we're not paying such a high rate, right? From a tax planning standpoint, I spend a lot more time focusing on the rates than what I do the dollar amounts. Right now, it's the way I was taught, and over time, that tends to serve people, I think, the best. To look at things from a long-term standpoint. Now, I didn't start this discussion off with right now this year, many parts of the country from the farm economy standpoint, we're probably looking at a kind of a rough year. I mean, we've had two rough years in a row where net farm income has not been great, and we're not projecting real good income, this year either. I'm going to talk about low income, what to do with low income, what to do with high income, because we may have to deal with both. Because folks, if you go back 5 years, we had tremendous profitability. I mean, unbelievable, never before seen profitability in the in especially in the row crop side of things. Now, the problem is most farmers are cash basis filers, and what they did is they did all kinds of things to stop from having to pay tax in those years that they had all that income. Now, the problem is that deferred tax liability keeps rolling forward, rolling forward, and rolling forward. So even though we might be in a year where we don't have such hot profitability, you still need to look at the books because you might have deferred tax liability rolling forward from the last 3 or 4 years. All right. And we still might have to deal with this year. So I'm going to talk about both. All right. So tax planning in low income years, if you're in a, if you're doing your tax planning and you've got that low income, you want to try and get that income at least up to where you're burning up your standard deduction on your tax return. Right. You're getting, I mean, on a 1040, if you're filing married filing joint, it's a little over $30,000 that you get as a upfront deduction. And if you don't have at least that much money on the front of the 1040, that's a deduction that gets lost and you never get it back. So, I always try to avoid losses on the overall tax return because you always end up losing money by unclaimed deductions anytime that happens. So always try to plan so that you got enough money to at least burn up that standard deduction on the tax return every year. Now, some things that you might be able to do that, to accomplish that, is you might want to accelerate some sales. All right. If you're having that planning meeting today and you're sitting down with the accountant and you run the numbers and you're going, well, you could really use some more income. Maybe instead of selling some of that commodity or commodity or livestock, might want to pull the trigger and sell something before the end of the year. All right, accelerate those sales, possibly postpone some expenses. Instead of spending money before the end of the year, postpone it and spend it after the first of the year. Uh, other items, we're going to talk about accelerated depreciation, which is 179 in bonus. We'll get to that here in just a little bit. Uh, we don't have to use that. We can just let our capital assets depreciate with normal depreciation. It's becoming less and less common, but you can still do that. Another thing you can do is you can amortize fertilizer. Now if you got a cropping operation and you have fertilizer expense, you can spread that fertilizer over time. Now, there's no magic number of years to do that. Uh, I've seen people in my part of the country that would amortize it over like 5 years, and that's I'm in a spot where we have pretty heavy soils. Uh, Somebody that has really lighter soils and sandy and light soils might want to do it for less. You might want to amortize it over maybe two or three, but just depending on that soil type, you can spread that fertilizer over time. Plus, another thing that you can do is you can capitalize repairs. If you got a whole list of repairs over the course of the year, you can just take those repairs and it's an election that you can make on the return and you can capitalize it. In other words, you're going to depreciate those repairs over a 5 or 7 year period of time. All right, which lessens your expense. All right. So those are things to do in low income years. Now let's shift gears and talk about, tax planning in high income years. All right. And we'll talk about these in much more detail. Uh, Tax planning, prepaying expenses. Now we'll talk a little bit about prepaying expenses. We'll hit income averaging, talk a little bit about deferring income for crop and livestock sales. Also, we'll talk a little bit about 179, that's accelerated depreciation, which is 179 in bonus. Also talk a little bit about crop insurance deferrals. So let's just kind of attack these one at a time. On the prepaid expenses, this is something as long as you're cash basis filer, and folks, 99.9% of farmers are cash basis filers. All right. I've been doing this work since 1990. In my 35 years of doing this, I have only ever worked with two people that were accrual basis. All right. And it just does not hardly ever happen. All right. Most people are cash. Now, the whole idea of prepaying expenses is as long you can prepay, and what typically what folks are going to prepay is uh, you might prepay your fertilizer for next year. You might prepay your seed for next year. You might prepay your chemicals for next year. You might buy feed for next year. All right. You're paying for those items that you're going to use next year, but you're paying for it in 2025, but you're not going to use it till 2026. But because we have a cash transaction in 2025, we're able to take that as a deduction. All right. Now, the general rule on this is that when you do a prepayment, that benefit of that payment cannot exceed the 12 months. The benefit can't be longer than 12 months or the end of the following tax year. All right. As long as it doesn't violate one of those two things, you're okay. Even like an insurance premium here. Like if I had a 1 year insurance premium that was paid in November and it's only for 12 months, well, it doesn't go beyond 12 months and it doesn't go till the end of the following year. So if I paid a insurance premium in November that was for 12 months, I can deduct it all in November. All right. Now, the one thing that we got to watch out for is at year end, you can't prepay interest at the bank. You can only deduct interest accrued interest that you paid. So a lot of times, what I've done with clients is, when they were trying to scrape together, every expense they possibly could, send them to the bank. They can pay up all their accrued interest. All right. And then that's a deduction for that particular year. All right. But you can't prepay. I can't prepay interest that's going to be accrued the next year. All right. That is not allowable. All right, prepaying farm supplies. All right, now this is the most common one that we deal with here, folks. Now, this is probably the most important slide on prepayments that I'm going to talk about. Number one, it cannot be a money put on deposit. All right, so the farmer can't go to the co-op and just write a check to the co-op and they put that money on account. That is not a prepayment. All right, when you do a prepayment, I'm walking into the co-op and I'm buying fertilizer, chemicals, seed, feed. All right, and I'm getting an invoice showing I paid this amount of stuff, I paid this amount of money for this stuff. All right, and I can show an actual purchase. All right. So, it can't be money on account, can't be a deposit. All right. It has to be a valid business purpose. And that's easy to fulfill that because when I'm prepaying, a lot of times what I'm doing is I'm fixing my price and I'm assuring myself of a supply. So those are our two business purposes for doing that. The publication 225 also says that we can't materially distort the income. But typically, when farmers start prepaying, they prepay every year, right? So we're not really materially distorting anything as long as we're practicing that every year. But this is real important, especially number one. That's the thing that I've seen more people mess up over my career probably than anything else. Is they went and put money on account and then they come to the appointment and they say, "Oh yeah, I prepaid this sort of stuff," and then I looked at the co-op bill and it's money on account. In fact, in some cases, they were getting paid interest for having that money on account. So they really didn't buy anything. All right. Next, what we want to talk about next is an underutilized technique that you probably need to have a conversation with your accountant about if they're not doing this for you. And that's income averaging. Now, income averaging can only be used by farmers. And it even IRS is going to admit that this is greatly underutilized compared to the number of people that could probably benefit from this. Now, income averaging is only for farm income. Now, it does not affect self-employment tax. It also doesn't change the taxable income. All it does is it changes our rates, is what it does. Now, here's a chart that I put together to kind of illustrate this a little bit. Now, this is an example that would work very, very well for a 2025 income averaging. Uh, now, this line right here represents the top of the 12% bracket. All right. So, and what we've got here is we've got income that was reported in 22, 23, 24, and we've got a big pile of income in this example for 2025. All right, and for 2025 we got income well into the 22% bracket as compared to the 12% bracket. Now, what we can do in this case is since we have unused brackets in these prior 3 years, what income averaging allows us to do is we can take an equal amount of money and put it into each of these prior 3 years. All right. And we can utilize the unused lower bracket from those prior 3 years. Now, let's just keep the numbers easy. Let's say, for instance, that I had $30,000 up in this block that's above the 12% line. And if I put 30,000 back, what I'll have to do is I've got to put by the rules, I have to put 10 here, 10 here, and 10 here. All right, I have to put an equal amount back into each of the 3 years. All right, so again, if I wanted to put $30,000 back, I'd have to go 10, 10, and 10. All right. And what I could do, and in most cases, I'd probably fill this up and maybe be a little bit above the line if I did that. But what I'm able to do is I'm able to utilize all of those unused brackets from the prior 3 years. This does not require amending the tax return. It doesn't require anything other than just filing a Schedule J. It's a two-page form and it's in your tax accountant software. It's really easy to fill out, and if your accountant doesn't know how to do it, have them give me a call. I mean, I'll walk them through the thing. It's not hard, all right, at all. But that's something to that can help you out a lot. Is managing that tax bill. Okay, so uh, deferring crop and livestock sales. Now, what what we talk about here a little bit is, you know, by deferring crop and livestock sales, what we're doing is we're pushing those sales into the next year. Now a couple things that we got to define here. It's one thing to, if I've got and again, I'm going to mention I don't farm, but if I did, location I'm at right now, it's largely corn and soybean production, and we got a lot of ethanol and soybean plants around the place. If I was a corn farmer here in Southwest Minnesota, and I had I had corn to sell, and I wanted to sell this to the ethanol plant locally, I might go ahead and contract that sale for next year if I wanted to push that income into next year. Uh, I I possibly already did contract for delivery, say in December. All right. And I'm obligated by contract. I might have to deliver corn to the ethanol plant in December, right now. And if I do that, I'm going to have to count that as income for 2025. Now, we'll get to the next slide here. I could do a deferred payment contract if I want to push that into the following year. What doesn't work, folks, is I can't take a load of corn to the elevator, run it across the scale, and then walk into the elevator and tell the elevator manager, I really want you to hang on to that check till after the first of the year, and I'll come back and pick it up then. That doesn't work because what you had is you had constructive receipt of income, which is a technical term, but that means you really had to take the money at that point in time. All right. At the point in time that I could receive that money, you got to take it. All right. Now, the way to combat that is you can do a deferred sales contract. Now, this needs to be a contract. This needs to be an agreement that's signed before you show up at the elevator or the ethanol plant. And what you're doing is you're saying, I'm gonna bring you a load of corn, but I'm going to sign a paper that says I don't get paid till after the first of the year. All right. And that's what a deferred payment contract is. Now, that works perfectly well. It's perfectly legal. IRS recognizes it. Two planning pointers that I want to share with you about that. When you do those things, you are an unsecured creditor, meaning if something happens financially to the buyer of that, if they file bankruptcy in the meantime, you are not considered a secured creditor, which means you're going to be the last person that gets paid when the bankruptcy court meets. So there is a risk involved with that. In fact, the other day on one of my ag newsletters showed up. Evidently, there was a big grain merchandiser in Nebraska that just went belly up, and that this is a large concern uh, from those farmers in Nebraska that were involved in that. So the other sales technique that I would encourage you to do is if you're doing a lot of deferred sales, instead of doing one big contract, bust it up into some smaller increments. And here's the reason why. Let's say, for instance, I wanted to, I was, let's say, for instance, I was contracted to deliver $100,000 worth of corn to the ADM ethanol plant here in town. All right. And I did a deferred payment contract. What I'm going to have them do is instead of having one contract deferring 100 grand, I'm going to have them draw up 10 contracts of 10,000 each. All right. The reason for that is when it comes time for filing the return, if we get to the end, if we get all the way to the end, we're getting ready to finalize my return, and we figure out, something, we really could use a little more income on the return this year. If we busted it into smaller groups on that deferred payment contract, we could pull one or two of those contracts back into 2025. And the only way we can do that is if we bust it into smaller contracts. All right. If I lumped it all into one contract, I either got to pull that whole contract back or I've got to leave it into 2026. I mean, there's no middle ground on that. So that's a planning technique that you want to be sure that you look at. Okay. I know I got a lot of livestock people out there on this call. So what we're going to do is we're gonna move on with this weather related provisions. Now, if you had to sell livestock because of drought, and Lord knows we've had a ton of that all over the country this the last few years. So if you are selling if you're having to sell livestock because of drought or weather related conditions, there are some provisions that allow us to do that. Now, I like to bust this into two different categories. All right, there's the breeding stock uh, deferral, which what we can do with this is, if you got breeding stock and you had to sell, say, for instance, some of your mama cows, and you just didn't have enough feed for doing that. What we can do with this is, we can sell this under this provision in the tax code. This is under 1031, no, excuse me, 1033. I misspoke. Under 1033, under 1033, we can sell that. We can defer that sale. What we have to do in this case is we have to buy the cows back within a certain number of years, and that depends a little bit. And the new legislation kind of expanded that. The general rule has been you got to buy them back inside of two. The new legislation did expand that a little bit. That's a conversation to have with your accountant on that, but because that replacement period can be extended if the weather condition does extend itself. Now, with a 1033 is, there's no disaster declaration that's needed with that. Now, the weather related sales of livestock, this works for animal raised for sale and breeding. This is all livestock. Now, this is under 451. And what this is where we can just, if we had to sell animals due to that weather-related sale, and we're just wanting to defer them into the following year. All right. Now, the difference with this is under 451, and under 451, we do have to have a federal disaster declaration. All right. There's no buyback involved in this. All I'm saying is that, normally we would sell these animals the following year. All right, because of the weather related condition, we were selling them early. What we can do is, even though we sold them in 2025, I've got the ability to defer them to 2026. All right, under that. But I do have to have a federal disaster declaration in order to do that. Now, the disaster declaration has to be either in your county of residence or it has to be in an adjacent county. All right, moving on here. Depreciating assets. The one of the things with depreciating assets that we have to pay attention to is when it's placed in service. Now, this has been a point of discussion with my group of farmers over many years. Uh, it took some training to get them all on the right page on this, but if I've got somebody with the association that went to the implement dealer and they went to buy a new piece of machinery, say they went to buy a tractor on New Year's Eve. All right, they show up on New Year's Eve to the dealership. They do all the paperwork and they sign the papers and everything, but they didn't take delivery of the tractor. All right, that does not constitute placed in service. Placed in service means that tractor has got to be on the home place. All right, ready for action. All right. If the paperwork is done, but they don't have delivery of the piece of equipment, it's not placed in service. All right. I've had people that bought a machine shed and the truck showed up and unloaded all the pieces and parts and everything all over the barnyard, but it wasn't put together. That is not placed in service because it wasn't ready for action. So we can't claim any expense on something until it's placed in service. Now, real quickly on this, new equipment is 5 year property, used equipment is 7 year property. All right. And the your grain bins, fences are still 7 year property. And the other pieces on here that we need to worry about, single purpose ag structures, which are predominantly hog confinement buildings, livestock confinement buildings, and also greenhouses will qualify as single purpose ag structures. Those are 10 year property. All right. Now let's move into the depreciation side of things. This is 179. Section 179 has been around for decades. All right, but the numbers have grown significantly from when I remember seeing 179 for the first time. The but What that works for is 3 through 15 year property, and the very next slide is going to show you what the different categories are. Our 2025 maximum is $2.5 million. So they put a lot of money towards this. And also the qualifying purchase limit is 4 million. All right. New legislation set that at the statutory levels. It's indexed for inflation. It's permanent, which means it'll stay in effect until Congress decides to change it again. But what that qualifying purchase limit means is if a farmer spends over $4 million on qualifying 179 property, you got a dollar for dollar reduction of what we can take for 179. So if you have a farmer that spends 6.5 million on qualifying assets, they're eligible for zero. All right, because they're 2.5 million over the $4 million limit. All right. So, once they go above 4 million, it's a dollar for dollar reduction. All right. This is a chart that I literally stole right out of Pub 225. This is coming out of the Farmer's Tax Guide. And what this does is this shows you the column that you want to pay attention to here is GDS, that's General Depreciation System. That's the one that most people are going to use. So drainage tile is 15-year property. I told you earlier, grain bins are 7. Looking for okay, fences are 7. Machinery, used machinery is 7. New machinery is 5. General purpose farm buildings are 20. And okay, I'm looking for my single purpose ag structures, which would be the poultry house. That's going to be 10-year property. So that's going to catch most of your farm stuff here. And you see whether things are eligible for 179. Essentially, everything on here is eligible for 179 except the farm building. All right. So it's 179 is pretty flexible in generating additional expense if you bought some capital assets. Now, bonus depreciation is also something we can use to write off capital assets fast. And now this works on 3 through 20-year property. So let me back up here a minute. Okay, bonus is going to work for everything on here, including farm buildings. All right, so that's kind of one of the differences with bonus. Now, bonus is like a light switch. All right, you decide to take it or you decide not to take it. Now we've got a real weird twist this year with bonus because the new legislation said that we can only take 100% bonus on anything that was bought after January 19th. All right, which January 20th was inauguration day, and this gets into politics, which I'm not going there. But this was the legislation was passed. So if you bought a capital asset between January 1 and January 19th, it's eligible for 40%. All right. If you bought something January 20th, between January 20th and the end of the year, it's eligible for 100%. And in fact, with the transition year for the stuff in that period of time, that January 20th through the end of the year, you got the option of either taking 100% bonus on that or 40% bonus, or you can completely elect out by class life, meaning that if I don't want to take it on any of my 5-year property, I'm going to click a box. If I don't want to take bonus on any 7-year property, I'm going to click a box. If you don't click that box and elect out, it takes it on everything. All right, that's the way it works. So it's much less flexible than the 179 because the 179 I can do that. I can elect that by class life is what I can do with that. All right. Crop insurance. All right. Now, crop insurance, I'll explain this real quickly. Now, if you received crop insurance payments in 2025, and we had a lot of parts of the country that did. Now, if you did get crop insurance payments, it is possible to defer crop insurance payments into the following year. Now, the provisions have to be that you have to be cash basis filing, and you need to establish that under normal circumstances you would have sold that crop the following year anyway. All right, and this is a crop deferral that's been around. Now, the part of this interpretation from the IRS that gets a little dicey with this is this revenue ruling from 74. All right, if you're doing this, you need to establish that every crop that you grew in 2025, you're selling over half of that crop the following year. All right. So in other words, if I was growing corn, wheat, and beans, all right, I need to show that I'm selling over half my wheat, half my corn, and half my beans the following year. All right. If that's all okay, if I'm over 50% on every one of them, then I'm okay to defer. If I fail on any one of those three crops, I got to keep it all in the current year. All right. I don't necessarily agree with it, but that's the way it's being interpreted. All right. I want to move into a tax planning piece here and take about 10 minutes to move through this, and then I'm going to open it up for questions. This again is the chart that we looked at earlier. Excuse me a second. Okay, this is the chart that we looked at earlier that shows our tax rates at various income levels for 2025, and this is also calculated on married filing joint status. Now, before I dive into this, I do want to. This is a snippet from the ruraltax.org website, and what I want to point out here is on that website, I do not want to diminish the need to go talk to your tax professional, but there is a farm income tax estimator that is free and available for download if you want to at home do some quick and dirty tax estimates. This is a downloadable Excel spreadsheet that you can plug your numbers into, and you can do a little bit of planning before you go see the accountant. All right. Now, moving on here. We got our 2025 tax brackets and tax rates. And as I said, folks, we got this has got all three filing statuses here, and we've got our rates running anywhere from 10 all the way to 37%. The thing that I want to point out here is the top of the 12% bracket for our particular exercise that we're going to look at here. 96,950 is the top of the 12% bracket for 2025. All right. That's important to remember that number. Now, let's go in here and let me give you the laydown of this thing. Okay, so we got a farmer that's coming in to do some tax planning. All right. They're, possibly coming in today, and they bring their accounting records, and I scan over the records, and we look at income minus expense. I know what their depreciation is going to be without adding any new without any without taking any fast depreciation, and their schedule F is going to be netting out at a couple hundred grand. All right. Now we go ahead and we take, I put this into software. We take the standard deduction. It's going to take that qualified business income deduction and deducts half the SE tax. And what we end up with, if we were to file that return the way it stands, we'd have taxable income of about 100, close to 124,000. All right, which would result in federal tax of 17 and change, self-employment tax of a little over 27,000. Grand total federal is going to be 44,283. All right, we're well into the 22% bracket. All right. So so what we're going to do, and let me back up here. All right. We go, no, maybe I won't. Sorry. Um, on this tax planning example, what we're going to what to mitigate this, all right, to mitigate this tax liability, what we decided to do is we're going to prepay $20,000 of 2026 crop inputs, and also we're going to take some fast 179 depreciation on some purchased equipment, right? Thus generating an additional $36,000 worth of expense. All right, which is going to reduce our Schedule F to 164,000 from 200,000. All right. So what this does is this takes the taxable income down to 96,733. Federal due is 11, self-employment tax 23, total tax a little over 34,000, but it's got us in the 12% bracket. Now, here's what I want to show you, folks. All right. We were at 196,000. Uh, wait a minute. Okay, we started at 123,000. All right, so we were at 123,000, which would have been about right here on the chart. All right, looking at that. We were at 123,000 taxable income. So we were in a really bad tax bracket on this particular deal. Now, through prepayments and taking some accelerated depreciation, we're going to move that client from here down to here at 96,000, which is the top of the 12% bracket. All right. So what we're doing is we're eliminating all this expensive money up here in the big green hump. All right. And so what does that do number wise? All right. So we spent 36,000 in the way of prepayments and accelerated depreciation. We cut the tax bill by right at $10,000. All right. And we're saving close to 30 cents of tax for every dollar that we spent on this tax plan. Now, the reason why when we look at this example, the reason why we're not saving 38 cents on the dollar is that QBI deduction. That QBI deduction, as we reduce the net, we also are cutting back on the qualified business income deduction. So it doesn't come out exactly right. All right. Be pre-QBI, I could pretty much say, oh yeah, you're going to save about 38 cents on the dollar, taking, getting money off this big green hump up here. This is really critical in that regard. Now, from a tax planning standpoint, if we're starting here and you want to prepay down to here, all right, you're not going to get as big of a bang for your buck because you're in a lower bracket. So you're gonna, so in order to get get that tax bill down, you got to spend more money to adjust that tax bill when you get into these lower brackets. Where it really makes sense to load up is when you're sitting up here in this high tax bracket. If we're sitting here and you want to buy down to here, that's a matter of probably just looking at the dollars on the thing. But because you're not going to get a lot of rate breaks. There's, going from here to here, you're not going to notice hardly any difference at all. All right. So that kind of wraps up a lot of what we have in the way of this tax talk. I do want to acknowledge our the Land Grant University Tax Education Foundation. I'm pulling a lot of the material from there, along with realtax.org and IRS. And with that, want to open this thing up for questions. And while we're doing questions, here's my contact information, folks. I do want to emphasize one thing. I do travel a lot this time of the year, and it's probably a good idea to initiate a conversation with me via email. I would really encourage you to do that because otherwise, if you call, you're probably just going to be starting phone tag, is what's happening. So, uh, Harley, do we have any questions out there?
I haven't seen any in the chat box or the Q&A box, but everybody should have the ability now to unmute themselves and ask any questions that you might have. Or you have the ability to still put these questions in the chat box and I can read them off for you if you're more comfortable doing that.
Or I can read them here too, but and don't be bashful.
And if it makes anybody more comfortable, I can stop the recording so that you have the ability to talk freely.
Good idea.